Hello, everyone. Welcome back to another edition of the Weekend Charts. Charlie Bilello here, and what a huge show I have for you today. If you're watching this on YouTube, just take a quick moment, hit that subscribe button for more content just like it. What are we going to be discussing today? A lot. We have a tale of two markets. Really, if it's been the best of times or the worst of times, depending on what you're looking at in the market. So we'll break that down. We're getting closer to a rate cut in September. We got new inflation data we'll talk about. The yen continues its decline, lowest level since the 1980s. Obesity drug boom. We'll talk about Eli Lilly, rising valuation ratios there. A lot of expectations in that stock. Nvidia today versus Cisco in 2000. That's the big comparison everyone's making. So we'll run through some charts on that. Rising housing supply is becoming a little bit of a theme here. We talked about existing home sales last week. Well, this week we'll talk about new home sales, some new interesting data there. Are Americans immune to higher interest rates? Well, we'll try to answer that question. Why hasn't the economy experienced a downturn yet? Why haven't we seen the consumer stop spending? And given that the fact that the Fed has hiked over 500 basis points, why hasn't there been a pullback? I'll discuss some of the reasons why that's been the case. And we'll end, as we always do, with something positive. That would be the travel boom that continues. A lot of spending there. We actually have a record numbers in terms of the number of Americans going to airports and traveling on airlines. So new records expected in the coming days as well. Expected to hit a record high this coming weekend. So let's start out with a tale of two markets: best of times, worst of times. Who's at the best of times for? Well, U.S. stocks, large cap stocks, growth stocks within the U.S. S&P 500 being the prime example. You can see here this year, up and to the right, minor pullback here in April, then raced right back to new highs, over 30 all-time highs so far this year. Incredible pace. Very few years show over 30 all-time highs for just half of the year. And if we're looking at the best starts to a year in history, this is actually, as it stands today, number 15 on the all-time list, up close to 15% for the index. And only 2019 in the past 25 years has had a better start than the current year. So we haven't seen this in a long time. You got to go back to the 1990s. We had a few years that had very strong starts here. You can see 97, 90, 95, 98 had enormous starts. But in recent years, only 2019, and actually last year was a pretty good start as well. So big question, of course, is, well, what does this mean for the back half? Not that much. There's no reason to expect the market will do the same in the back half of the year. Almost always you have a lower return after such a strong first half of the year, and that's just because there's mean reversion in markets. You don't tend to see this pace continue. If you look back in history, top 20 starts here, only 1954 had a better second half than a first half. So expectations should be lower returns for the second half, but it doesn't have to be negative, as we've seen here. Was it negative in 2023? Was it negative in 2019? But back half of the year, probably should be expecting another correction. That would be very typical. You tend to have between 3 and 5% pullbacks, and we've only had one so far this year. So in terms of expectations, were people predicting that this would be the 15th best start to a year in history? Absolutely not. This is Wall Street strategist targets. The table that I love to show here, showing you all the targets entering the year for the S&P 500 for the end of the year. And you can see here the average was expecting just 1 to 2% gain for the S&P 500 at 4861. We're already at close to 5,500, above every single strategist prediction. So trouncing expectations. Nobody was expecting such a strong start to the year. In terms of the NASDAQ composite here, hit another huge milestone this week. 18,000 for the first time. It was only a month after we hit 17,000 for the first time. So rapidly moving higher here, 6% gain, another 6% gain in the last month. And if we look at the last 7 years, you could see a number of these milestones. Actually, the index has tripled since 2017. So over the last seven years, it's tripled. And then if you look at the 17 years before that, it only increased from 5,000 to 6,000. So what happened in between? Well, of course, we had the dot-com bubble peak in March 2000. Took a long time for the index to recover. It was down over 80% after that peak. And what a difference we've had in the last 7 years here, just hitting new record after new record in terms of the NASDAQ and growth stocks leading everything. And speaking of growth stocks, this is probably top 5 growth stories in history for the market. Amazon.com went public in June 1997 at a market cap of 442 million. And very rare, of course, today for a big tech company to go public at such a low valuation. We'll talk about that in a little bit. But look at what it's done since that IPO. It's increased 4,560x to hit 2 trillion this week for the first time. So joining that $2 trillion club, just an incredible story of growth for Amazon. And if we look at the percentage of people that use Amazon in the US, this is intuitive. This makes sense. It's almost in every household now ordering from Amazon, using their products every single day. So delivering value for the US consumer, and it's been rewarded now with a $2 trillion market value. And was this predicted at Amazon's IPO? I went back and looked at an article from Fortune back from September 1997, talking about why Barnes and Noble might crush Amazon. Selling books online was a neat concept. The nation's leading bookstore is turning into a cutthroat business. What's a poor startup to do? And essentially, what the article was arguing is that Amazon was going to have a tough time, and Barnes and Noble was the leader in the space, and it was going to be very difficult to overtake them. And we know what's happened since then, and it just goes to show you, in terms of predictions and predicting one of the most amazing growth stories in history, a lot of people doubted that. A lot of people didn't see it coming. Now this year, in terms of large versus small, this is pretty historic. We haven't seen a spread this wide. It's looking at 15% spread between the S&P 500 and Russell 2000 so far this year. That's the widest spread that we've seen since 1998. So there's that 1990s comparison once again. If we look at the last 2 years here, 2023 and 2024 so far, you can see that kind of parallel. We haven't seen back-to-back years like that since 1997, 1998. So huge spread between large and small. And interesting thing that some people are arguing is the case. Why are small caps not doing as well? Well, some people are saying, well, it's because companies are staying private longer, and you're not getting that gain, that benefit from them being in the small cap indices, because by the time they're going public, they're already in the large cap space. And I think one example you could point to of that would be SpaceX today, which just crossed above a valuation of 200 billion. Pretty incredible, because back in a decade ago, it was only at 10 billion. So we're looking at 10 billion to 200 billion here in the last 10 years. But I looked at what it would be in terms of the S&P 500. Where would this rank in terms of market cap? It would actually be 35th largest company in the S&P 500. So interesting that companies seem to be delaying going public for longer. They're having, it seems like, not very much trouble raising money in the private markets. It doesn't mean they're never going to go public. There's chatter about SpaceX going public in the next few years, but you can see here, very different story than, let's say, the story of Amazon, where it went public at a much earlier stage in its lifetime. So we'll see what happens here in terms of will we start to see new issues earlier in terms of their life cycle, and has that really changed, let's say, the small cap market? I don't know that you can definitively say one way or another, but clearly there's been a change in terms of the IPO issuance in the past, let's say, 10 years versus back in the 80s and 90s. And perhaps you can make that case that we're not seeing these companies early on. The quality companies, the good companies, aren't coming public early enough for investors to benefit from that. So if we're looking at the markets this year, what has been the best of times? Well, you can see here the left side of this table here: U.S. large caps, U.S. growth stocks, U.S. stocks in general, semiconductors, short duration, and U.S. dollar. And who's been the worst of time? Well, small caps lagging large caps. Here looking at total returns, 17% spread here. Growth versus value, 15% spread with growth beating value. US versus international, 10% spread. Semiconductors versus regional banks, 55% spread. Short duration, which is simply treasury bills versus long duration, over 10% spread. And we have the dollar ETF up 7.6%, and the Japanese yen, as we'll talk about in a little bit, ETF down 12.6%, 20% spread. So enormous spread. You don't tend to see this across the board in so many different areas. So it's been a very unusual first half of the year. And the question, of course, for the second half, are we going to see this maintained, this spread? We're going to see it lengthened, or are we going to see finally a mean reversion? As we talked about last week, a number of these spreads looking at large versus small, growth versus value, US versus international at extreme levels, and we just haven't seen that mean reversion take place. So if you're watching this on YouTube or watching this on X, all of the weekend charts viewers can now get a free wealth path analysis for my company, Creative Planning. Go to the link in the show notes, creativeplanning.com, Charlie, to get your free wealth path analysis. What do you get with that? Well, you get a lot. You get a free portfolio checkup. You get a look at your retirement. Are you on the right path? We also do tax planning, estate planning. So we'll tell you if for taxes, do you own the right assets in the right areas? We'll look at asset locations, tax loss harvesting opportunities for estate planning. We'll make sure everything is in order. So reach out today, creativeplanning.com/Charlie. We're in all 50 states, 300 billion in assets under management and advisement. Well, we're here to help. Schedule a call or meeting today. Number two, getting closer to a rate cut. This is an interesting data point that we got today. The fact that core PCE, which is the Fed's preferred measure of inflation, moved down to 2.6%. That's the lowest we've seen since March 2021. This is the one that they really look at very closely. And as you can see here, trending in the right direction. And the gap between the Fed funds rate and this core PCE is now 2.7%. That's the highest we've seen since September 2007. So tightest monetary policy we've seen since September 2007. And many people are saying, well, if this continues here, this will be enough for the Fed to cut rates. Not in July, not at the next meeting in July, but more likely for it to happen in September. So I think over 60% probability of the Fed cutting in September. And here's what the market's expecting today. We're expecting a hold in July, a Fed 25 basis point cut in September, another hold in November, 25 again in December. So it's kind of every other meeting, 25 basis points cuts here. And you can see these expectations today. But as we've said, these expectations have been completely wrong so far this year. Remember, entering this year, market participants were expecting 6 to 7 rate cuts this year. Now they're expecting 1 to 2 rate cuts. So huge shift already. And if we get any increase in inflation over the next few months, you could very well have a scenario where the Fed doesn't cut rates at all this year. But assuming this core PCE continues to trend lower, moves down, let's say closer to 2% in the coming months, the Fed will likely, I think they want to cut, they will likely get closer to having that confidence that their 2% target is going to be achieved, and they'll at least throw the market a bone and give that first 25 basis point cut. But until you see it move closer, it's still too early to tell. And a lot can change, of course, between now and then, particularly with the areas that are sensitive to fluctuation like food and energy. If we see commodity spikes, prices spike, or other things spike, it's going to be a much more difficult time for the Fed to be thinking about cutting interest rates. So we'll see what happens here. Expectations for September, but with every data point, these expectations change, and we'll see into that July meeting what they say. Likely, in my view, telegraph it. So if they are going to cut in September, I think they're going to give a very strong signal at that July meeting to say we're finally ready to do that cut in September. So number 3 here, down goes the yen. Japanese yen, just a continuation of a long trend here of lower levels versus the US dollar. It's actually down now 53% versus the dollar since its peak here in 2011, and just an incredible decline, lowest since 1986. And the Bank of Japan has pursued this lower, weaker currency policy for much of this period. Remember, Japanese Bank of Japan had negative interest rates until just recently, kept interest rates negative for a very long time, has been purchasing on their balance sheet enormous amounts of Japanese government bonds to try to manipulate interest rates and keep them low. So you just have this huge differential in policy rates where the US Fed now is restrictive, tight monetary policy, and the Bank of Japan, even though they moved rates back into positive territory, are still negative in terms of that real rate, negative 2.8%, where you can see the Fed funds rate 2.1% above CPI overall here. So huge differential, I think, driving the yen lower. You also have the fact that economic growth in Japan over the past year has been negative. And in the US, we know it's close to 3% if we're looking at real GDP. So you have a differential there. The big question for the Bank of Japan is going to be how much more are they going to try to fight the trend of higher interest rates, and how much more of a decline in their currency is going to occur before it becomes really problematic. And if we look at the Japanese 10-year yield, they've let this float higher this year. So they've stopped buying as much bonds as they were before, let this float higher. You can see here now we're above 1%, the Japanese 10-year. It's the highest since 2011. And if they let the free market go to work here, it would probably be significantly higher than this. How much higher? No one knows. I think the broader point and the lesson the Fed should take away from this is it's a dangerous game to play, this manipulating rates to this extent. And for a long time, you could see here the negative interest rates they had or close to zero for the 10-year bond. And that was just because they were doing massive buying of securities, the Bank of Japan. So how will they transition to a more normal environment? Will they eventually hike rates to a more normal level? I think so. As long as inflation stays elevated here, we're at 2.8%. They don't have the deflation problem that they worried about for so long. They don't seem to have it anymore. They should normalize policy. Will they do so? I don't know. Maybe the Japanese yen has to go even lower. But lesson for the Fed, don't follow this policy. My view, you don't want a weak currency like this. It's better to have a strong currency, a strong dollar. So it's good that that dollar is strong, especially when we're importing goods. It lowers the price of those goods. I don't think you want to see your currency do what the Japanese yen is doing right here. So not a model to be followed, in my opinion. The obesity drug boom, talked about this before, but I just want to briefly touch on Eli Lilly because it continues to march higher here. Over the last 10 years, Eli Lilly, one of the leaders in the obesity drug boom, along with Novo Nordisk, up 1,120% in the past 10 years. Just an incredible run. And what I'm comparing it to here, which is very interesting, is its net income growth, which is 81%, and its revenue growth, which is 69%. So clearly a huge gap between the fundamentals so far and the stock performance. And what does that mean? That means investors are expecting these to go substantially higher in the years to come, driven by its obesity drug. And the numbers that they're throwing out in terms of demand for that drug are just incredible. But we'll see. Is this too big of a gap is the question for investors. Are they getting overly excited? Eli Lilly now is the 8th largest company in the S&P 500 here. Market cap is over $800 billion. Not far from Berkshire Hathaway here, above Tesla, you can see. And you can see its net income and revenue compared to Berkshire Hathaway, not even close. So clearly, again, investors expecting a lot. We could see that from the price to sales ratio here, which is getting kind of ridiculous, above 22. You don't tend to see that, of course, for a pharmaceutical company, but we've never seen a drug like this in terms of demand and expectations. So perhaps this is simply reflective of investors expecting just enormous growth rates over the next year, similar, let's say, to Nvidia, what they were expecting a few years ago. Are we going to see that for Eli Lilly? We'll keep a close eye in the coming quarters. Nvidia versus Cisco. This has been the one everyone's talking about. Nvidia today versus Cisco back in 2000. Nvidia, of course, benefiting from the AI boom. Cisco was benefiting from the internet boom back then. And if we look at the parallels here, I'm just going to run through a few charts. Nvidia in the past 5 years up 3,440%. Cisco in the 5 years leading up to its peak in March 2000 up 3,590%. If we look at valuations, we can see the expansion last 5 years for Nvidia going from 9x in terms of price to sales to 42x in a 5-year period. Cisco moving from 7x to 39x back in the 1990s to it until its peak in 2000. And if we look at, interesting here, last week we talked about Nvidia passing Microsoft to become briefly the largest company in the world with a market cap of $3.33 trillion. Well, interesting that back in March 2000, the company that Cisco passed was Microsoft as well. So you have this interesting parallel here where growth rates very similar over the last 5 years, valuation expansion over the last 5 years, and both passing Microsoft to become the largest company in the world. And the overall trend in terms of technology, speaking of March 2000, well, very interesting this month, the ratio of the tech sector in the S&P 500 to the overall S&P 500 hit a new record high, surpassing the previous high from March 2000. So the outperformance of tech versus the S&P 500 now at a new relative all-time high. So a lot of parallels with March 2000. Are we as crazy? People keep asking me, is this as crazy as it was back then? Definitely not. Even the comparison to Nvidia and Cisco notwithstanding, there was a lot of other garbage companies that simply had very little revenue back then. And I'd say that the closer parallel to back to the 2000 period would be what we saw in early 2021 with the growth stock boom and the SPACs and the IPO issuance that we saw back then. And many of those stocks, interestingly, haven't recovered. So they're down. A lot of them went down 80, 90% and have not come back. So what we've seen really is the comeback in the biggest stocks within the tech sector, the Microsofts and Nvidias and those types of names. We haven't seen it in terms of the marginal names. So every time is different. It's not exactly like March 2000, but I'd say other than March 2000, this would be the period you look at in terms of extremes, in terms of growth versus value, large cap versus small cap, and US versus international. This would be number 2, let's say, on the list of most extreme examples. Number 6 here, rising housing supply. We talked about the existing homes last week. Today, I want to talk about new homes. Speaking of housing here, first we got to look at prices, and prices continue to go up. U.S. Case-Shiller National Index hitting another record high, up about 6% over the last year. And you can see here the divide between prices and affordability. Affordability near record lows, prices at all-time highs once again. And so the two are obviously related. Prices go up way more than incomes. Over the past 5 years, you're going to see affordability collapse, and throw on top of that the fact that mortgage rates have gone from under 3% to 7%. Well, you have a double whammy in terms of what's hitting new home buyers. So if we're looking at the Case-Shiller 20 City Index here, you can see every single city in the index up over the last year. Pretty good dispersion here in terms of the worst performing city. Portland up 1.7% and San Diego up over 10% in the past year. But what you should really be looking at is the last 5 years. In the last 5 years, we're talking about crazy numbers, 52% for the Case-Shiller 20 City Index. That's an enormous, enormous increase, obviously, in a 5-year period. Incomes up nowhere near that. So you're talking about 20% increase in incomes, and home prices over 50% higher than where they were 5 years ago. Something has to give when that's the situation, and what's giving is activity. We talked about existing homes last week. We got new data for new home sales. They're down 16% year over year. big factor being that these new homes are simply not affordable at current prices and at current mortgage rates. And if we look at the inventory of new single family homes, really starting to build here, 481,000 now is the number. That's the highest we've seen since January 2008. And if we look at the month supply of new single family homes here, over 9 months supply, rare to see supply that high outside of a recession. So if we're looking back in history, we have the 73, 75 recession, 80 recession, 81, 82 recession, 90, 91, and 2008, 2009 recession all featured these spikes in housing supply, which makes sense. You lose your job, it's a bad economy, you're not going to be going out and buying new homes, and inventory builds, and you see this increase in supply. The difference this time is we're not yet in a recession. We're not seeing big job losses. What's driving it is the affordability, the lack thereof. So the fact that new entrants into the housing market can't afford that new home, well, demand has absolutely collapsed. So you're seeing this inventory build up, and this is just a comparison from 4 years ago. Last week I did it with existing homes, but here's the comparison for new homes. 4 years ago, you had a 30-year mortgage rate at 3%. Average new home price was $369,000. Today, 30-year mortgage rate is 7%. Average new home price $525,000. So obviously, both numbers moving in the wrong direction for affordability. So what's the result of that? Well, if you're putting 20% down, 31,000 increase in down payment. So you got to save $31,000 more today than 4 years ago to buy that home. And here's the big one here. 124% increase in the monthly payment. So it went from $1,245 per month to $2,794 per month over this 4-year period. And once again, people's incomes have not gone up 100% over the last 4 years. So you have an absolutely unaffordable housing market and new homes inventory. The reason they're going up, number one, would be that lack of affordability. Now, what caused home prices to go up? So obviously supply and demand is a factor, but we cannot ignore the increase in the money supply. As Milton Friedman said, inflation is always and everywhere a monetary phenomenon. You could see the increase in the average new home price and the increase in the money supply, very similar over the last 5 years. So we printed a lot of money. We sent out a lot of money in terms of stimulus. We borrowed. We did deficit spending. And the result of that is we debased the currency and asset prices went up. So what we're seeing here is the blue line is money supply. You can see the spike, and then with a lag, you see prices go higher. And the interesting thing, of course, here is over the past few years, money supply has gone sideways, and so has the average new home price. So what will happen going forward? Yes, it's going to depend on supply and demand, but it will also depend on whether we do another crazy move higher in the money supply. I don't think that's coming. Hopefully it's not coming, but we are now showing positive year-over-year numbers for the money supply after a long stretch here where we're showing the money supply actually contracting a little bit. Now we're up a little bit. So what we don't want to see is this go up like crazy again. That would be very bad for inflation and for housing affordability. If we could just hold the line here and be prudent in terms of the money supply in the coming years, I think that would be very helpful. Existing home supply is also, of course, a factor in terms of the housing market, a much bigger factor. Although a third of the homes I think available today are new homes, historically, it's been much more driven by existing homes. So we still have very low existing home supply. So the fact that new homes supply is high, well, yes, that might help bring down prices in terms of new homes, or at least prevent huge price increases in the future. But that's not going to have that big of an impact on existing homes. We need to see existing home supply continue to move higher. And we are actually seeing that. If we look at active listings of homes for sale, they're up now 17% year over year, highest levels we've seen since 2022. And unlike the past few years, at this point in time, we're seeing bigger price drops in terms of people are lowering the prices of their listing price in order to stimulate demand. And the reason for that is, again, that affordability equation. no affordability. You got to cut the price of your home. And we're seeing now homes selling below their listing price, not typically seen this time of year for the housing market, especially the past few years. So we're actually seeing before the seasonal week period, which would be the winter months, we're seeing homes selling below their list price. So if this trend continues, if we see listings continue to go up, we see inventories continue to build, that should help pricing pressures. As we said, if you look at the Case-Shiller National, still hitting record highs, up 6% year over year. I think if we look at the back half of the year, we're going to see that rate of change really slow down because of this building inventories. Okay, number 7, this is the big question. Why haven't the Fed's interest rate hikes hit the American household? Why are so many people seem to be immune from higher borrowing rates? Well, here's the data that really answers that question. Only 11% of household debt has adjustable rate interest rates. So the vast majority of people who have debt, it's mortgage debt, it's fixed rate debt, and it's not changing. It could be even student loan debt. It's fixed rate. It's not floating. So the Fed's hikes have no impact on it. So that if credit card debt, different scenario. You have a credit card debt. It's very difficult today because you're at a 21% interest rate, a record high. But if you locked in a mortgage rate at 3% or 4% and you haven't moved since then, well, the Fed interest rate hikes really aren't hurting you very much. And if you have a savings account where you have money built up there, the hikes actually are helping you because now you're earning more in interest income. And I think that's a huge, huge factor in this chart right here, which is showing you household debt service as a percentage of disposable income. So the amount that you're spending to service that debt as a percentage of your income still pretty low here, 9.8%. You can see nowhere near what we saw at the peak before the financial crisis, was around 13% in the fourth quarter of 2007. Nowhere near that, below the average of the past 40 years. And a big reason for that, again, is the fact that most people are locked into low mortgage rates. And another reason is that the population is aging, and many baby boomers now have their mortgages paid off. And you can see that in this chart here. From 2010 to 2022, the percentage of U.S. homeowners that are mortgage free has gone up here from around 33% to above 39%. So as this trend continues, fewer people are impacted, obviously, by those rising interest rates, and this will likely continue as long as activity remains low, as long as the population continues to age, because you paid off that 30-year mortgage and you have very low new activity in the market. So just a greater share of people have no mortgage in terms of the U.S. population. And if we look at the composition in terms of fixed versus floating, as you can see here, most people have a fixed rate mortgage. Very few people have variable rate mortgage. 96% of the mortgage market is fixed rate in the U.S. That's different than places like Europe and Canada, which typically more typically have some variable rate mortgages. The U.S. market is mostly fixed rate. It's gotten more fixed rate over time. So again, huge factor. And if we look at the effective rate, so you hear a lot about 7% mortgage rates, 8% mortgage rates in recent years, and that's had a huge impact on new home buyers. So people coming into the market today obviously makes it unaffordable. But if you're still in your home, you have your existing mortgage. If you look at the entire data set here, the average rate on all mortgages outstanding is still below 4%. We're at 3.8%. So huge gap between what the new mortgage rate is, around 7%, and what the effective rate, let's say, is on all mortgages. So the debt service is still very manageable for most people. And like we said, the fact that the mortgage is fixed and now you have a higher income, you're earning more on your interest savings. A lot of people have benefited from this because they have a fixed amount of debt and their income is now higher. So a inflationary period is actually good for people that have existing debt, not good for people that want to take out new debt. So S&P 500 versus the Fed funds rate, and those last few charts that I showed you there should be explaining why this shouldn't be such a huge surprise. How is the market at new all-time highs? How is it 26% higher than when the Fed has started hiking interest rates back in March 2022? Well, it's because the US economy has grown since then. Corporate profits are higher today than back then, and the big driving factor of that is that so many households are immune from these higher interest rates. Now, the longer these rates stay higher, which is why I've been arguing the Fed should stay restricted for longer, the longer they stay higher, the more impact it will have in terms of demand and in terms of eventually people have to move and they'll have to get a new mortgage and so on and so forth. The longer that goes on, the more of an impact. But so far, this has been really the story telling you why the market has been so resilient, why the US consumer has been so resilient to rising interest rates. And speaking of US consumer, we'll end with something positive as we always do, and that would be the travel boom that has continued. What's driving that boom? Well, it's higher incomes. If we look at real personal incomes in the US, excluding transfer payments, this is inflation adjusted, hit a new record high in May, up 2% over the past year. And what are people doing with their savings? Are they spending it on goods? Are they spending it on retailers? Not so much, as we talked about. Retail sales continue to be very weak. What they're spending it on is travel, is experiences here. And this is showing you U.S. airline data going back to 2020. You can see the huge drop during COVID. Took a few years to get back, but now not only are we back, we're hitting new record highs. The top 5 travel days on airlines in history have all occurred this year, and the top 2 have occurred in the past week. And the expectation from the TSA is that we'll see a number above 3 million for the coming weekend. So great news. People are traveling again, people are going places, and they're valuing experiences over goods, and the economy is strong enough, and there's a job market strong enough, and wages are high enough where people are still spending. So we'll end it right there. Thanks everyone for joining me. Have an awesome weekend. If you're watching this on YouTube, take a moment, hit that subscribe button, hit that like button, leave a comment, and I'll see you next time on the Week in Charts.